أعزائي طلاب الفرقة الرابعة بشعبة اللغة الإنجليزية، السلام عليكم ورحمة الله وبركاته. Today we are going to start a new chapter and the last chapter in our course, Chapter 8, Translation of Foreign Currency Financial Statements. Our learning objectives are describing the conceptual issues involved in translating foreign currency financial statements. Then we have to explain balance sheet exposure and how it differs from transaction exposure. Third, describe the concepts underlying the current rate and temporal methods of translation. Fourth, apply the current rate and temporal methods of translation and compare the results of the two methods. So we have four learning objectives, and later we are going to explain them in more details. In today's global business environment, many companies have operations in foreign countries. These operations located in foreign countries keep their accounting records and prepare financial statements in the local currency using local accounting principles. To prepare consolidated financial statements, parent companies must restate their foreign subsidiaries' financial statements in terms of parent company reporting generally accepted accounting principles, and then translate these statements into the parent company reporting currency. Therefore, if you have a company located in Egypt, this company will adopt generally accepted accounting principles of Egypt and is using the Egyptian pound as its functional currency. If this company has a foreign subsidiary, have a foreign operation located in the United States of America, the foreign operations will use American GAAP and will use the United States dollar as its currency. In order to prepare a consolidated financial statement, the parent company, which is located in Egypt, has to first reunify the accounting principles, which means reunify the difference between the United States GAAP and the Egyptian GAAP. Therefore, it will be able to go to the next step, which is translating the financial statements, which means change the currency of foreign operations to Egyptian pounds. In translating foreign currency financial statements into the parent company's reporting currency, two questions must be addressed. The first question is, what is the appropriate exchange rate to be used in translating each financial statements item? Should we use the current exchange rate, the exchange rate at the end of the year, at the balance sheet date, or use the historical exchange rate which is prevalent at the transaction date, or the average exchange rate? So we have three exchange rates that we could use. Current exchange rate is the exchange rate as of the balance sheet date, or historical exchange rate, or average exchange rate. Which of them should be used to translate each item of the financial statements? The second question is, how should the translation adjustment that inherently arises from the translation process be reflected in the consolidated financial statement? The translation process will result in a translation gain or loss. How this translation gain or loss be reported in the financial statements? Balance sheet exposure. As exchange rates change, Assets and liabilities translated at the current exchange rate change in value from balance sheet to balance sheet in terms of the parent company's reporting currency. Then these items are exposed to translation adjustment. But balance sheet items translated at historical exchange rate do not change in parent's currency value from balance sheet date to the next. Then balance sheet exposure means assets and liabilities which are exposed to translation adjustment. Assets and liabilities translated at the current exchange rate. The current exchange rate means the exchange rate at the balance sheet date are exposed to risk of translation adjustment. Of course, if this exchange rate differ from the previous exchange rate, from the previous balance sheet exchange rate. When foreign currency appreciates, when foreign currency increase in value, a net assets means assets are more than liabilities. A net asset exposure results in a positive translation adjustment. But when a foreign currency appreciates, a net liability exposure results in a negative translation adjustment. Assets and liabilities translated at historical exchange rate are not exposed to translation adjustment, as the historical exchange rate do not change from a balance sheet date to the next. Four major methods of translating foreign currency financial statements have been worldwide used. The first method is the current non-current method. The second method is monetary non-monetary method. Third method is the temporal method. And finally we have the current rate or closing rate method. Later we are going to handle each method separately. The first translation method is the current non-current method. The rule for the current non-current methods are as follows. Current assets and current liabilities are translated at current exchange rate. Non-current assets and non-current liabilities and the stockholders' equity accounts are translated at historical exchange rate. However, there is no theoretical basis underlying this method, and this method is not allowed by US GAAP or IFRS and is seldom used in any countries. To remedy this method, researchers have developed a new method which is monetary non-monetary methods. The second method is monetary non-monetary method. Under this method, monetary assets and liabilities are translated at the current exchange rates. Non-monetary assets, non-monetary liabilities, and the stockholders' equity accounts are translated at historical exchange rates. So what are the items to be considered as monetary assets? Monetary assets are those assets whose value does not fluctuate over time. For example, cash and receivables. Non-monetary assets are assets whose monetary value can fluctuate. They consist of marketable securities, inventory, prepaid expenses, investment, fixed assets, and intangible assets. That is, all assets other than cash and receivables are considered non-monetary assets. Monetary liabilities are those liabilities whose monetary value cannot fluctuate over time, which is true for most payable. Under this method, under monetary non-monetary method, cash, receivables, and payables carried on the foreign operations balance sheet are exposed to foreign exchange risk because they are translated at current exchange rate. There is a net asset exposure when cash plus receivable exceeds payable, and a net liability exposure when payables exceeds cash plus receivable. So balance sheet exposure here concerns only cash and receivables and payables. If cash and receivables are greater than payable, then we have net asset exposure. If cash and receivables are less than payables, then we have net liability exposure. The translation adjustment measures the net foreign exchange gain or loss on current assets and liabilities as if these items were carried on the parent's book. This is the idea of this method. The third method is temporal method. The basic objective underlying the temporal method is to produce a set of parent currency translated financial statement as if foreign subsidiary had actually used the parent currency in its operation. Consistent with the temporal method underlying objectives, assets and liabilities reported on foreign operations balance sheet at historical cost are translated at historical exchange rates to yield an equivalent historical cost in parent currency terms. Conversely, assets and liabilities reported in the foreign operations balance sheet at current or future values are translated at the current exchange rate to yield an equivalent current value in parent currency terms. And as it is true under any translation method, equity accounts are translated at historical exchange rate. The temporal method generates either a net asset or a net liability balance sheet exposure, depending on whether assets carried at current value are greater than or less than liabilities carried at current value, because these items are translated at current exchange rate. Items carried at current value, if these items are greater than liabilities carried at current value, then we have net asset exposure. So we have net asset exposure when cash, marketable securities, receivables, and inventory, when all these items are carried at current value, is greater than liability. We have net asset exposure. Because liabilities current plus long term usually are greater than assets translated at current rates, a net liability exposure generally exists when the temporal method is used. Again, a net liability exposure generally exists when the temporal method is used because liabilities usually are greater than assets translated at current rates. Under the temporal method, income statement items are translated at exchange rate that exist when the revenues is generated or expense is incurred. For most items, an assumption can be made that the revenue or expense is incurred evenly throughout the accounting period, and an average for the period exchange rate can be used for the translation. However, some expenses such as cost of goods sold, depreciation of fixed assets, and amortization of intangibles are related to assets carried at historical cost. Because these assets are translated at historical exchange rate, the expense related to them must be translated at historical exchange rates as well. The fourth and last method is the current rate method. The fundamental concept underlying the current rate method is that a parent's entire investment in a foreign operation is exposed to foreign exchange risk, and translation of foreign operation financial statements should reflect this risk. To measure the net investment exposure to foreign exchange risk, under this method, all assets and liabilities of foreign operation are translated using the current exchange rate. Equity accounts are translated at historical exchange rates. The balance sheet exposure measured by the current rate method is equal to the foreign operations net assets position, which means total assets minus total liabilities. If total assets is greater than total liabilities, we have a net asset exposure. Under the current rate method, revenues and expenses are translated using the exchange rate in effect at the date of accounting recognition. In most cases, an assumption can be made that the revenue or expense is incurred evenly throughout the year, and an average for the period exchange rate is used. However, when an income item such as gain or loss on the sale of an asset occurs at a specific point of time, the exchange rate at that date should be used for translation. Alternatively, all income statement items may be translated at the current exchange rate. In the next slides, we are going to see a tables show a summary for the difference between the major translation methods and the main translation methods used and recognized by the accounting standards, which are current rate method and temporal method. As we see in this slide, we start with the assets of the balance sheet and what is the exchange rate to use when using the current rate methods and the temporal method. In the first column, we have the name of group of assets. The second column shows what exchange rate to be used in case of current rate method. Third, show the exchange rate to be used under the temporal method. Under the current rate method, we see that the current rate is used for all assets. However, under the temporal method, current rate is used only for items carried at cost, such as cash and receivables, marketable securities, and inventory at market, as they are measured at current cost, not historical cost. However, inventory measured at historical cost, or prepaid expenses, or property, plant, and equipment, or intangible assets, they are all translated at historical exchange rate. In the other side, liabilities and stockholders' equity, as we see, stockholders' equity is translated used historical exchange rate under all methods. But liabilities under the current rate methods are translated using the current rate, and under the temporal method, only current liabilities and long-term debt are translated using the current rate. However, deferred income is translated using historical cost. The last slide to indicate the difference between the current rate method and the temporal method gives the exchange rate to be used when translating income statement. The average exchange rate is used under the current rate methods for all income statement items. However, under the temporal method, some items are translated at historical exchange rate when the item is related to an asset which is translated at historical exchange rate. Otherwise, we use the average exchange rate. What about the translation of retained earning? The translation of stockholders' equity. All methods use the historical exchange rate to translate stockholders' equity. But stockholders' equity items are translated at historical exchange rate under both the temporal and current rate methods. This creates somewhat of problem in translating retained earning, which is a composite of many previous transactions. Revenues, expenses, gains, losses, and declared dividends occurring over the life of the company. In the next slide, we will show how to translate retained earning. We start with the beginning retained earning in a foreign currency, and this is obtained from the last year translation. So, we start with the beginning retained earning in the parent company. We add the net income in foreign currency, and this is translated per method using translated income statement items to have net income in foreign currency. Then we can subtract dividends in foreign currency, and this is translated using historical exchange rate, the rate when the dividends were declared. And by adding net income and subtracting dividends, we end with the ending retained earnings in the parent currency. The complicating aspects of the temporal method: keeping a track of historical rates of inventory, prepaid expenses, fixed assets, and intangible assets is necessary under temporal method and not under the current rate method, as translating these assets at historical rates makes application of the temporal method more complicated than the current rate method. Also, we have complication with regard to cost of goods sold, with the application of lower of cost or market rule, fixed assets and depreciation and accumulated depreciation. Disposition of translation adjustment. Translation gain or loss in income and net income. Translation adjustment is considered to be a gain or loss analogous to the gain and loss arising from the foreign currency transaction. Should be reported in income in the period in which the fluctuation in exchange rate occurs. However, translation gain or loss cumulative translation adjustment in stockholders' equity is one alternative to reporting the translation adjustment as gain or loss in the income statement. This treatment defers the gain or loss in the stockholders' equity until it is realized in some way.